Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 102. As always, joined by the three amigos. We got Keith Dicker, Ice Cap Asset Management. Patagucci Vest is on. It must be fall season. And Rich Diaz, the Tom Brady macro, wearing a new headset in a new room. New man. Rich, what's going on?
Nothing. My computer is very poor and it doesn't like the Wi-Fi, so I've been relegated to yet another room. But that's not what's going on. What's going on is I have an announcement to make. So we've been pretty cagey because there's some compliance stuff that we needed to work through. But I've joined a new company, as I'm sure some of you guys have probably already figured out. It's called PGM. I'm PGM Global. I'm quite proud to have joined them. I'm a global strategist here. We have an awesome team doing much of the same work that we did before, but for like a broader base of institutional investors. PGM also does best execution trading, and they have got an excellent award-winning transition management business. So you'll be hearing more about that as we go through, but I'm really excited to finally let you guys all in on the secret. Otherwise nothing much changes. Loads to talk about today. Loads of funny data points that I think we're going to have a good time talking about. And that's it, boys. So there you go. Now everybody knows.
The chains have been unshackled.
That's right. I'm no longer the Tom Brady of macro. I'm now
Mr.
Global
PGM
strategist of PGM Global. So there you go.
I didn't know this was happening. Did you, Steve? This is my first time I'm hearing of it.
Yeah, first time.
Well, boys, I'm sorry I lied to you.
Do you notice with these?
Because Rich, you've been quiet on Twitter.
But Rich is with
too.
a great firm. That's going to be great. But you ever notice, Rich, with these firms, it's always best execution. Nobody ever advertises that it's okay execution, right? It's always best.
No, but
so
what
if everyone
is
the best, but everyone's the best, then it's average, right?
That's true. What is interesting is because we don't have a prop book, it avoids a lot of the sort of agency principal problems, which a lot of these businesses and banks do have, which is they front run trades of their clients and they do all kinds of other shenanigans that, of course, they say they don't. But anyway, that reminds me of a movie that's coming out soon. What is it? The movie about GameStop?
Oh yeah, saw that.
What's it called?
I don't know.
Anyways, it's gonna be really cool. Anyway, there you go. Let's go, boys.
Do that stuff. Okay, what we got today? What's Boomer doesn't have any awesome stories this week. That's it.
That's rare, okay. Man. What a disappointment, man. Episode 102 off to a tough start.
But
I mean, to be quite frank, I think it's actually been an incredible week for global macro. Keith, you've talked about it a lot, but if you're not, if you're a portfolio manager, not excited to get up in the morning, I mean, you're in the wrong profession. It's been, we had Canada CPI come out this week, surprising to the upside. We'll get into that. We had the Fed, which everybody was waiting for, the Bank of England, the Swiss Central Bank, just loads and loads of data points as markets sort of restart their ignitions as we get into the busier fall market. People are back in full swing, and I think we're tiptoeing into something pretty ugly, but I'm sure we'll get into that into the show. As always, go ahead.
It's something that actually reminds me. Do you guys remember the TV show The A-Team back in the 80s?
A Pity the Fool.
I've seen the movie, the remake.
Mr. T.
Yeah, that's right, Mr. T. But the main guy, he was Hannibal. He was like the leader, right? And he had this catchphrase at the end of every episode at some point. He pulls out a cigar and he always says, "I love it when a plan comes together." And Steve, I think that's what's happening right now with markets. A lot of things that we've been talking about and sort of envisioning that, the path that we're going towards will start to come together. And I think everything is converging closer and closer. So this would be a good conversation tonight.
You'll own nothing and be happy plan is coming together.
I think you're right.
He's looking forward to eating the bugs.
No
Oh,
bugs.
I do have a story actually. So I wake up
You
this morning and get ready, doing stuff, getting ready, and I turned to Mrs. Icecap and I said, "Do you think I should change my T-shirt today?" And she looked at me. She said, "Well, you've been wearing the no central bank digital currency shirt for 7 days straight. I think you should change the T-shirt."
Nice.
So I
Man,
did. That was my.
she's a lucky lady.
She's something. She's something.
But yeah, I mean, starting things off, quick little housing update. Yeah, what are we? Third week of September now. So typically, for anyone that maybe is less familiar with housing, there's a seasonality to housing, and so usually, typically in the summer, you get the seasonal slowdown, and then usually September, October is the seasonal uptick, and then you'll slow down into sort of late November, basically through until mid-February, and then you start your spring market, which is typically obviously very high sales volume, tend to get higher prices. Actually, there is a seasonality to pricing as well, and so coming into this September market, we have talked about it quite a bit on the show. It was going to be another good test, right? Because you're going to get the seasonal uptick in listings. And the question was, are you going to get the seasonal uptick in demand? And I would say so far, I think we're getting the seasonal uptick in listings, but the demand has not been there to meet it, which really shouldn't be surprising given where mortgage rates are at in the 6 handle. And I think we're starting to see a lot of the cracks forming again. And I think it's going to be a good test. On the one maybe more positive side, we've talked a lot about the supply side of it. I think the governments are finally starting to come around and making some pretty bold changes. So we had the federal government, as horrible as they've been on the housing file, they did remove the GST on purpose-built rental buildings. We talked about it briefly last week with Ben Rabideau. But essentially, it's a 5% savings right off the bat to any developer that's going to push through rental housing. And this is really to help them offset, I think, which is rising costs of construction financing, the still elevated cost of building, and most of these projects are obviously being put on the shelf due to what's happening in the economic environment. So the Bank of Canada, ironically, through the rate hikes, is killing demand, but they're also killing the CapEx side of things, which is future housing supply. So the government is trying to sort of counterbalance that by removing the GST. So I do think it's good policy. The Conservatives had also proposed it in their platform. So the Liberals almost kind of took that from them. And then
Steve, I have a question for you. Have you been chatting with any developers about this? Are they excited about it, or is it?
No, yeah, they are. Yeah, super excited about it. I mean, I think don't get me wrong. I still think there's no the full removal of the GST is not going to prevent housing starts from getting crunched over the next 12 to 18 months. It's going to save a bunch of projects. There's obviously quite a few developers right now that were planning to launch, pre-sale condos to sell and are trying to pivot to rental because the market's not quite there. And so getting that extra 5% is probably going to keep some of these projects from being permanently shelved. So it is a big change.
It will help to at least continue some of the supply that is supposed to come on stream, as opposed to
it's going to help offset, I think, some of the carnage. I still think permits are a leading indicator. They're getting just mullered, as you would say, and so that's a positive note. But I think we're setting up the framework for once you kind of get out of this cycle, this downturn. I think that we are putting the right pieces in place. The city of Vancouver passed they basically removed single family zoning in the city of Vancouver, and they allowed multiplexes now. So on a standard lot, you could build up to 4 units. So that's
huge, isn't it?
Yeah, I think it's pretty big. It's going to get uptake. I know it is in parts of the city. It's not necessarily going to be immediate because, like I said, at the end of the day, it's, interest rates trump a lot of things and a lot of policies. City of Calgary, they also passed they banned basically single family zoning in the inner city communities. So you can basically, they took what was single family zoning and they changed it to what they call as RCG, which basically allows you to build like infill row homes essentially, or townhouses, whatever you want to call it, on single family lots. So you can see these large municipalities. So I think we're making some good progress. But like I said, at the end of the day, I think the housing market is really sucking wind right now. And I think that you can tweak policy as much as you want, but I think there's the laws of economic gravity, I think are gonna pull housing starts down.
Well, thank God we're going to get a soft landing. We don't have to worry about. Hey, Rich, you remind me, you look like a helicopter pilot, by the way.
Oh,
with your
thank you.
Headset.
That's the nicest thing anyone said to me over the last 2 days.
I do have a story actually. So things are getting pretty nasty in the pre-sale space in the GTA. So GTA, I think has way more speculation. Maybe I'm naive or isolated here in Vancouver, but clearly the GTA is going through a sharper correction than, let's say, Greater Vancouver. But the pre-sale space, there's a ton of speculation there. So you're seeing a lot of people getting caught offside, which is like, hey, I bought this pre-sale 2.5 years ago. I never really had the financial means to close on it. Thought I could flip it. Turns out it's an illiquid instrument. And I can't get approved for financing with an 8% stress test. So you're seeing a lot of anecdotal stories coming out of the GTA on that side. But I was chatting with a fairly large Canadian bank this week. And I asked the question. I was like, hey, like in Vancouver here, are you seeing any of these issues start to pop up? Okay, very sporadically here and there, but it kind of led to this conversation, which was, well, some of these banks have these auto appraisals, or they call them basically blanket appraisals on projects. And so what I mean by that is, imagine you bought a townhouse pre-sale or a pre-sale condo, and let's say you paid, let's say for the condo you paid $800,000 2 years ago, and it's coming up for completion, and now it's only worth $700,000. So normally what happens is you go to get your mortgage at that particular lender. They're going to give you the appraisal value. So they're going to appraise it and say, well, it's worth 700. So we'll lend you, 80% of 700. So you got to come up with the difference. Now, in some of these projects, and not a lot of them, but it was this, this guy's telling me this story, is that this large Canadian bank had what they call as a blanket appraisal on the project. So I'm assuming they had basically done this. They usually do it like well in advance. So what that means is they didn't have to if you were going to get a mortgage to this lender, that lender had done a blanket appraisal on the entire project. So so they don't basically look at what is today's value. They said, well, when we appraised it 18 months ago.
Got it.
Which I was like, man, that seems kind of crazy, because it's like,
well, they work with the developer, right? Surely. If the developer's making 30 units, they'll just say, okay, if anyone comes and buys these 30 units, is that right?
Correct. Yeah, essentially. And which, I was like, well, I kind of get it. But I was like, yeah, it seems nuts, because if you think about it, like the bank could be issuing, 95% loan to value mortgages on, half the units, hypothetically.
Yikes.
They think they're
banks
making
in Canada are perfect and amazing, and they never make any mistakes, and they'll be totally fine. And isn't that right, Keith?
Is that a recommendation you just made? Your compliance
Absolutely
department
not.
are going to lose it.
Disclaimer.
It was not a recommendation in any way, shape, or form. Oh boy. Well, it's been fun, boys.
Thanks a lot.
We will be auditioning for a new Rich next week.
Oh, it makes me sad.
Need a handsome guy who's very lucky all the time.
That's right. Laughs at my own jokes.
Keith, I thought you might appreciate that bank story, though. I know you're a big Canadian bank proponent.
Yeah, yeah. We have these conversations all the time, and to think what's so great about the Canadian economy and Canadian bank story is we have this, I call it this false sense of security and invincibility, in that because in our lifetime we've never experienced a banking crisis of any kind. we feel that it can never happen. And that's a linear thinking. And we don't live in a linear world. It is a cyclical or secular world, depending on what time frame you're looking at. And, we just happen to believe that the probability of this perfect world continuing for the banks, it's a lot less than it has been in the past, like in the last 40 years. And Steve, you mentioned earlier today, if you're an investment manager with GUP, you're not excited, and that's absolutely true. There's so many ways that you can structure your investments these days to provide yourself with protections, in case things do go a bit off. And there's about 4 different things now that can just pop up from anywhere, and then the wheels will fall off, and Rich's headset will pop off his head, something like that.
I do prefer the microphone, but my computer's acting up, so I'm forced to look like a helicopter pilot.
But your voice sounds like you. It's very rich.
Oh, good. Thank you. Very good. Okay, what else?
Well, we had Canada's CPI, so that was fun.
That was fun. That was good.
What was what was the expectation? I think it was like 3.8% year over year, and I think we got, was it 4.1?
No, 4.0, right on the nose.
Right on the nose. So we're back to 4s. Now, keep in mind, we had Ben Rabideau on the show last week. I highlighted some of his research at the live event in Vancouver, which, what did we do that in July?
Yeah.
Where Ben's research at the time basically said there's a pretty straight line here from 2.8% headline inflation back to 4 easily by the end of the year. So we got to 4 here in September, so it was obviously quicker than anticipated. But I have to wonder, who is advising Chrystia Freeland? Who is advising? Because, remember, she did the happy dance. Isn't it a great thing? She was doing all these interviews, 2.8% headline inflation. It was like.
And the G7 comparison.
Oh, Jesus.
By the way, everyone listening, whenever your government pulls out a G7 comparison to prove how great things are in your country, you want to start squinting your eyes at it and, put some salt on it, because it's that's the trick, right, Steve?
Oh, I mean, anyways, Chrystia Freeland, Ben Rabideau, North Cove Advisors, highly encourage you to go sign up, subscribe. There should be a Loonie Hour promo code that she can use. But I think this was like totally Rich. I mean, you're the PGM guy here.
Oh boy.
But I think, simple year over year base effects. I feel like this could have easily been foreseen.
It was foreseen. I mean, so first, there's lots of stuff to unpack here. First of all, Ben Rabideau was absolutely right. I think he's a lovely guest. He's really smart, and he nailed it. But with respect to Ben, it wasn't exactly that hard, right? If you remember, his analysis was simply repeating what we had seen over the last couple of months. And so what I mean by that is, like, so you have like a year-on-year number, which was 4%, up from 3.3. And then you have a monthly change, which would have been, let's say, 0.2.
I think it was 0.2, basically.
Yeah, 0.2, 0.2, or 0.1. And so what he simply did was he just ran through a bunch of different scenarios, not even that many, if I remember correctly, which is, no change over month on month, 0.1, 0.2, 0.3, whatever. And then he just had, a scenario analysis, which I thought was actually very clever and very well done. But again, he's not a rocket scientist. And so that's why we made the point at the time, which is like, just be careful with claiming victory after one data point, because, Steve, as you know, life comes at you fast when you can't do math. And that's why, kids, you got to learn math at school.
Keith, but what do you learn any math?
Yeah, it doesn't come across very often. I actually am good with numbers, but so from our perspective, like when the CPI data came out, I don't know if you guys touched on it then or not. I apologize, but all of the numbers were greater than estimates.
Right.
So when it first came out, so for example, like the year-over-year number, like it was 4, but the market had priced in 3.8.
That's right.
And 3.8 versus 4, people might say, well, who cares? You just round it. But in the investment world, it's a big difference. And because the actual number was greater than what's expected, it gives the investment world a new narrative to say, wow, inflation is out of control again. The Bank of Canada is going to have to hike rates. And so immediately the Canadian dollar, it did the opposite of being mullered. It went vertical. And but all of these inflation numbers, they're all greater than what was expected. Who wants to take the underhand pitch, talk about why the numbers were greater?
I do.
You do? Go ahead. Wait, let's wind up. You ready? You got your bat ready?
Okay.
Toss it.
This is the easy. This is the right down the middle. Okay, so everybody knows. So we know 4% is the top headline number. So I'm not going to do the whole thing, but let's just talk about the contributions, which you would have heard on your nightly news. Number one was everybody talked about the mortgage interest payments, which I think got a huge negative backlash and relates to the comments and the letters that people sent to the Bank of Canada, which makes us look like a banana republic. But the things that stood out, according to them, because they always put a list. Remember, all this stuff is online. It's for free. You just need to Google like CPI print, CPI release. It's actually really well laid out. And so it actually says like the main contributors to the 1 month change were gasoline prices. I'll let you guys figure out why or why not that's gone up. I mean, that's tongue in cheek, of course. Gas prices across the world are going up. Brent is now 95. I mean, I think WTI is flirting with 91 and 92. So we've had a major change in the oil and crude oil landscape that wasn't helped by certain policies, which, you can figure that on your own. The other stuff that was interesting was
let's not figure it out. Let's just tell everyone what it was.
All right. It was the carbon tax. I just think we're beating a dead horse. I feel sometimes it's some of these
we have new listeners, but again, oil prices are going higher listeners. Again. That is happening. Refined oil that has a spread, of course, all that. But all of a sudden, the climate change tax, who is it hurting most at the pump?
It's hurting poor people who are not subsidized to buy electric vehicles. I mean, ultimately, that's ultimate people who cannot readily change their cars or either swap their cars or lease new cars, or don't get massive subsidies for their hybrids or what have you. Like one of my very best friends who makes an absolutely incredible amount of money, who got $15,000 check from the government to purchase a new car. But anyways, the other thing so Keith is right. I'm sorry for our new listeners. And then mortgage interest payments were a big contributor, 2.7%, which is a huge number. That's related obviously to the rising interest rates and to the people who are starting to, what's it called? To renew their mortgages. The other thing that I thought was really interesting was rents. So rents are obviously a big contributor to the data, and rents rose to 6.4%. So this is a chart that you shared with us a while ago, Steve, that was related obviously to population growth. It's also related to the fact that as interest rates get higher and higher, and normally, let's say you normally go and buy a house, your interest rates are low, you can afford the mortgage, what have you, but as interest rates get up higher and higher, you can't necessarily afford that mortgage. So a larger pool of people actually get sort of shifted into a different housing market, in this case, the rental market. So it's there's several factors that are attacking it.
Can I just chime in there? Yes, the CPI rented accommodations was over 6%.
Yeah,
keep in mind, I think we talked about this last week, 2 weeks ago, which was, rents in the US, apartment rents are actually literally zero growth and probably going to turn negative next month. Whereas Canada, you're still seeing record high prints in rents. Up officially per rentals.ca is showing a 9% growth on a year-over-year basis. So again, for those that are maybe skeptical on the supply side, I would argue that the rental market is typically a pretty good indicator of supply and demand. Yeah. So, can rents come down? Yes. Usually with job losses, that will certainly help. But obviously 1.2 million people coming into the country is still pushing rents higher. So that's another policy error.
Steve, you've mentioned something really important, and I think that it's gonna sort of chimes my last little bit here, and then I'll pass it to Keith. But it's the idea that there are different ways to measure these different indicators and different line items in your consumer basket. We understand that there are issues in calculating it. I would submit to anyone who complains that it's false or misleading, you go figure it out. Because I think that, for all the misgivings we have about Canada and Canadian policy and whatever, I think StatsCan does as good a job as any statistics house in the world as figuring out what through their lens is the change in prices. Now, obviously, you can corroborate that with different sources. And why that's important is because there are different measures for core inflation. There's something called common, there's something called a weighted mean, and there's a trim mean. The common is based on a model, basically. I don't really understand how it works, but the weighted mean is just simply those weighted. And the key one for me is the trimmed mean CPI, which is what they take out, they exclude the highest movers and the lowest movers to narrow down a central tendency for what's going on CPI. And what I think basically will bake another interest rate hike into the Bank of Canada before the end of the year is the rise in 2 of the 3 measures. So Keith, I'm interested in hearing your view on what might happen, but that's really important. Those core CPI measures, remember, they exclude food, they exclude energy. These are real central tendency measures on inflation. They rose from 3.6 to 3.9, 3.9 to 4.1, and the other one was flat at 4.8%. So it's not over, kids.
Well, it sounds to me like you're actually interviewing for another new job with Stats Canada right now.
Oh, no, come on.
Nice build up.
These people work hard. They get a lot of stuff right. We shouldn't always shit on them.
That's fair. That's fair. I don't know what you want me to comment on the CPI data. I mean, what's...
Well, Keith, what I would be curious to hear your opinion on is fairly unusual, but it seemed like Canada, which is a tiny little fraction of the global economy, which I would say most of the world doesn't really care about. It seemed like that CPI print in Canada moved like the global bond market.
It because it was sort of first up, and now all that's been repriced again. Like all the gains on the Canadian dollar has been given up, and we're back to where it was pre-announcement. But I think all this sort of ties. We had that number come out, of course, and then the market very quickly discounted it as being because of oil prices, gas prices, and the climate change tax they have on it. And then thereafter we had the Europeans. They came out, and then and again, like we haven't talked about it yet. We had the Fed meeting yesterday, which sort of ties everything nicely together. We will, because it's hard to talk about. We're Canadian centric, Canadian focused, but as we talk about frequently, that as Canadians we have to be aware that the world doesn't go around us. We're sort of moving around the world, where we're impacted by everything that happens elsewhere, as opposed to Canada moving the world around. But again, like this morning and yesterday was an unbelievable day in the world, because you had the Fed. This morning you had the Brits, and then the Swissy as well. But the underlying concern right now, because the market has suddenly shifted, and we've been waiting for this for a while. The financial markets were waiting for central banks to say, okay, we're not going to raise rates anymore. And it's finally arrived. We've been waiting a year for this to happen. I don't say we as in me, we as in, generic market. And, we also talked about, as soon as that happens, then the view is going to turn to, whoa, are we going to get a recession or a soft landing? And that's happened very quickly over the last 48 hours. And then that's what ties into the whole inflation story. Because, inflation is going to be impacted by supply shocks or demand shocks. So in Canada specifically, we had both happening at the same time. So the supply shocks got hit, with the global policies towards the COVID pandemic, paid everyone to stay home. No one lost money. Governments took on debt, and supply chains got severely disrupted, and they're still not back on side yet. And of course, in Canada, the demand got boosted higher, with the population growth, and so you have that happening right now. So these inflation prints coming in, we still tend to look at it as the Bank of Canada. They're very clear now. They're saying, hey, we're going to watch this. We're on pause. We don't want to increase more. We're waiting to see what the rate cycle is going to do. But the risk we have here in Canada, and people say, well, it hasn't happened yet. Just like that voice, Rich? It hasn't happened yet. Yeah. You got to do that sometimes, to
Do it
make
again?
a point. Yeah. Hasn't happened yet. I have a friend. There's a friend who does that all the time. It's very effective.
Is it?
Yes, absolutely. But the point is that what we've been waiting for our portfolios, we've been watching these cycles come through. So it was our expectation that oil and agricultural commodities and that gas would sort of be floating along during all summer and then start rising in Q3 and 4. And that's really happened with food agriculture as well as oil, of course. And it hasn't happened with nat gas yet, but we're well positioned for that when it happens. But with equity markets, it was our expectation that equities would, should hit a summer high and then come down here in the fall as the market begins to appreciate that the probability of a recession or even a hard landing is a lot higher. And I think that's what's happening. And that's where I know we're painting the story that inflation numbers are going to go higher, but the great offset to higher inflation data is the economy just getting stopped in its tracks. And that's the risk we have coming up here. And that's what we're excited about, Steve. What are you excited about?
I thought you were in the soft landing camp.
I've never been in the soft landing camp. Rich likes nice soft things.
No.
Everybody has. Well,
to quote Marie Antoinette,
cuddly.
let me quote Marie Antoinette. There's nothing new under the sun, only what's been forgotten. And a friend of mine sent me, I saw this on Twitter, I think it was on Twitter or something, but if you
know Marie Antoinette?
I do know Marie Antoinette. She's great. Well, what I said to you guys, I can't remember I saw that, so forgive me for not giving it the appropriate credit, but someone, I think his name's Michael on Twitter, brilliant follow. And someone basically just Googled like soft landing, and then you can narrow your search scope on Google, obviously. And if you just do like November or whatever, 2006 to 2008, naturally it was a lot of the soft landing talk. Now, the cycles are wildly different, specifically because the US does not have a housing bubble and it's delevered massively. However, the talk of soft landing comes up again. I think it comes up every time there's always some kind of slowdown.
So by the way, yesterday with the Fed, we had the quote of the year.
David.
Well, maybe
we're
it's
not there yet.
Are we not
I know.
there yet?
I won't let it out of the bag. Maybe it's the second quote of the year behind your friend Marie Antoinette. Was she an Austrian diplomat? What was she?
No, she was King Henry XVI's wife. She got her head lopped off in the French Revolution.
I just like hearing you tell us these stories.
I thought Freeland had the quote of the year so far.
What was that?
Which one? What did she say?
The inflation one.
Oh.
2.8. Isn't that great? Yeah.
Never count your chickens.
Man, we should totally clip that one in.
Interest rates are at historical lows, Greg.
All right, that was a good one.
That's another good one too. But we will come back to that quote, and it is the money quote. It is so this is Thursday. We record on Thursdays, and on Thursday, the markets equities are getting mullered again here this morning. Continuation from yesterday afternoon, which was driven by the quote. Which we go, we're going there, Steve. We're going to go
Just
there.
Do it.
All right, let's get there. I mean, I was going to chat. I wanted to circle back on the on what's happening in the bond market because I think that's really like the big story here.
It's all tied together as well.
Let's jump over to the Fed.
Steve.
Yeah, so the Fed. So this is why you just can't read headline news or read the minutes that come out, or the press release. So the Fed did that. They had what's called, Steve, what do they call it?
The dot plots.
No, it was a hawkish pause.
Yeah,
panic pause.
Steve had the quote 2 weeks ago, I think.
No, Canada's was a panic pause. The Fed's was a hawkish pause.
So where should Steve's quote be ranked then? In the top 3?
He's number 1 in our hearts.
He's number 1 in our hearts. Okay.
That's all I can ask.
But what really happened with markets yesterday during the presser, they do that, the Q&A. And I always talk about how the Europeans always have their best one. Years ago when Draghi was there, he was
amazing.
He had no idea what was going to happen. Like that was another. By the way, if you have a chance on the Google YouTube to just research and find the video when you had I think they were FEMA protesters came in, the ladies that would take off their shirts and to protest a point.
That's your favorite movie, isn't it?
No, it's PETA, I think, wasn't it?
PETA, oh, whatever. But they actually stormed the ECB presser once. I don't know if you remember that.
I do. He threw cash. Didn't they throw like fake money at Draghi? Or was that?
But they jumped up on the table and they did this in front of him. That's why you get that famous Draghi picture. He's like, like he said, something's happening. But so we had nothing nearly as dramatic as that yesterday, for the average folks. But for Loonie Hour folks, of course, we had a really special moment. And what happened? Powell, this is what he specifically said. When it happened, I said, wow, I can't believe he said that. And I was texting with one of my friends about it. But Powell said, it was Brent, yeah. And, we had a big fight then on text. He didn't say that. I'm going to say he did say that. And then we went to the Bloomberg screen and, they have the red highlights. And he said, he did say that, right? Because markets just went nuts.
This is the milkshake man, Brent Johnson, by the way, for those.
Yeah. So what Powell said was, I wouldn't call soft landing a baseline scenario. So when you hear that for the first time, because you guys don't listen to this stuff, of course, what does that imply to you?
Me?
Well, it's only two of you there.
He's not buying the news headlines.
No, what it means is the baseline. I mean, baseline is like your most expected, or let's say worst case scenario, right? So what he means is that's not
worse. You're the one with the highest probability.
Yeah,
that's your baseline.
That's right. That's right. Your baseline is your highest probability. So that means he thinks that a hard landing is probably his most likely probability.
And that caused markets, to go in a bit of a shit show there for a little bit. And, again, it's like everyone in the world, like we're all having this conversations like in real time. Did he just say that? He didn't say that. No way. You're trying to figure it out.
On.
Yeah. And all of a sudden, about 20 minutes, like markets are trying to figure out if he actually said it, which he did. And about 20 minutes later, I think it was the Wall Street Journal reporter. I'm really glad he actually went back. He said, a few minutes ago, I want you to clarify. You said a soft landing is not the base case scenario. He said, did you really say that? And then Powell started backpedaling. Well, no, I didn't quite say that. He started to do that. But now, the genie is out of the bottle and all that stuff. But it's now set up this point where, fast forward today, you had the Brits, you guys can talk about the Brits and the Swiss, what they did or didn't do. But again, it's all connected. But this was a whopper. But what happened, Steve, with the bond market with all this going on?
Yeah, the bond market got mullered.
It did.
It's getting mullered today too.
Yeah, it's getting mullered like 2 days in a row.
This is getting out of hand.
It's like a weekend in the middle of the week.
But Keith, that's like what can you maybe shed some light on that? So if the base case, if a soft landing is not the base case scenario, generally when people are worried about growth, they buy bonds and yields go down as the price goes up. Now we're seeing sort of the opposite sort of happen, which is yields are going up and bond prices are going down. So people are selling those bonds in a scenario where you've outlined that people might be worried about growth. So can you explain why that might have happened or how that's happening?
Yeah, absolutely. Because equities are coming off because all of a sudden, I get, how like you guys are, you're a yield guy. We joke about that all the time. I'm not a yield guy. I'm not a earnings valuation guy either. But I imagine right now in the equity world, everyone's saying, oh, wow, if we go into recession, we got to cut earnings. That's going to affect earnings multiples and all that stuff. And, equities are selling off. If you're in the bond world, you're saying, oh, boy, okay, that's going to mean there's less money available to pay, coupons and debt rollover, stuff like that. Plus, the economic data in the U.S., it's still strong.
Yeah, it is still strong.
It's not weak. And the Fed, because yesterday they had the hawkish pause is what, some people are calling it. So the Fed is saying, yeah, we might get a recession here coming. That's now what we expect is going to happen. So you equity folks, you're screwed. And bond guys, you're screwed as well because we're going to keep hiking. Because the only way to get inflation under control is to just crush demand. That's what they want to do. So maybe they're getting to it. I think if you're losing the S&P now, Rich, are we getting closer back to the June levels
Oh,
in the
we are.
S&P?
I'm looking for my 200-week moving average. That's what I'm looking for. But that's a little while ago from now. We're
Yeah.
not
So
we're not there
so
yet.
I mean, what
You
a
have to,
financial crime, Steve. Like you have the
well,
whole summer, all the gains you had in the summer are now gone.
yeah, we're back to the late June, or almost there anyways. Late June levels.
Well, basically, Keith, like the bond market is going to end up doing the legwork for Powell and Tiff Macklem and all these guys, right? I mean, you look at, I think the U.S. your average 30-year fixed mortgage has now ticked up to about 7.3%. In Canada, obviously we've talked about it. Your Canada 5-year bond, which is what everybody looks at to price these mortgages, that's up 30 basis points in the past week. And
Really?
that's
1 week?
30 bips. Yeah.
Holy moly. Okay.
30
Sorry.
bips this week alone. And that's the highest since, I think, what is it, June or October of 2007. And so, I think if you thought, 6.2% mortgages were going to be tough in Canada, I mean,
So Steve, is that like 17, 18-year high now, correct?
somebody do the math for me. 16-year high, 2007.
For what? Sorry?
I think the 10-year just hit that, like the highest yield. Steve was quoting the 5-year.
Yeah, and the Canada 5-year bond is also like the highest since 07. So yeah, I mean,
And that's a point that, we talk about it all the time. And, we had rates peak. Rates were low in the 60s. They peaked in 1982. And then they went down to zero in 08, 09. And then the yield curve was suppressed, for over a decade. And now rates are going up again. And people are saying, holy smokes, how does this happen? Our models aren't working and stuff. So again, like we have so much debt accumulated over the last 15 years now that, someone's going to be on the wrong side of this. And if one person can't pay back their bond, the money that they borrowed, it's tough on them, of course. But who is it worse? Who is it worst for?
The lender?
The buyer of the bond, the investor.
Yeah, the lender.
So
if you lend
Okay.
money, you're buying. Anyways,
I look
never
at it as
mind.
an investor. Yeah.
But just to answer your question, the 5-year Canadian bond is 4.23. So let's say 4.25, and the last time it was 4.25 was, let's call it 2007, the late end of 2007.
Yeah.
Okay, what was the
So-
number one pop song on the charts in 2007?
I have no idea.
But there was a lot of, hey, Rich, there was a lot of
Look it up, Rich. Look at it. This is good stuff, Steve. People
Keith,
need to know.
you're active in the business in 07. I'm sure there was a lot of soft landing calls in the summer of 07.
I think what is it, Rich?
Oh, Irreplaceable by Beyonce? I don't even know that song, but Umbrella, that song I know. Anyway,
Umbrella,
sorry,
yeah,
Steve.
Umbrella was a banger.
Yeah.
I don't know. I will never bring this up again. I'll never do that again.
Steve,
what
were
I
you gonna
can
say?
tell you,
Sorry.
Steve was asking about the environment back in 07. From the beginning of like Jan of 03, that was roughly a year after the Americans went into Iraq, and which was the market low, because 2002 was the worst equity market year I've ever experienced. In that, like everything was down 2% a month for a year straight. But from like 03 up to about 07, the end of 07, it was like 5 years of you didn't have to do anything. The American economy was zooming and there's no risk anywhere. It was all about, again, these cycles we're coming into. So back to
Keith,
the bond market.
Sorry,
Yeah.
just to that point. So oil prices hit a high of 133 in June of 08.
Mhm.
I know.
Yeah.
I feel like secularly, like I think there's a pretty strong argument for oil given the lack of investment, but you have to wonder. I know all these oil bulls on Twitter and inflation, but you have to think if we're going into what we think might be a hard landing. I mean, I don't know if you have to be worried about where oil's going now.
Yeah, so I was one of the greatest trades that I was involved with, over my 80 years of managing money was back during that market. So if you look back at the oil chart at that time, like it went, I think it hit like 140 almost, Steve, at one point. But it was the speed, the acceleration, the velocity of that, because it went from like 100 to 140 very quickly. And so when if you have a gradual movement to any market up or down, you just adjust to it. It's fine. But I remember back then, this rapid movement, with oil, and so we're, in our global equity portfolio that we were running, we look at this and we, very quickly, we say, quick, let's run correlations on which sectors, subsectors, industries, you name it, who has the highest negative correlation to oil prices. And you can probably guess what they are. You want to have a guess? Which stocks do? Yeah, airlines, absolutely. So we said, quick, we go to the airline, the guy that covers the it's consumer discretionary, Rich? Are they in?
Yes, sir.
They're consumer discretionary. Yeah. Quick, what's the best airline stock to hold? And he looked at it, he said, man, they're all crap. Like they look horrible on every single metric. And we said, that's easy. We'll just buy them all. So like 4 of them. So we stuffed them all in. But the point is, as soon as oil, it ran out of energy. Do you get it? It's
Oh God.
It ran out of energy from going so high, and it fell off quickly. These airline stocks, they just did a slingshot into the air, into
These
space.
airline stocks right now aren't looking too hot, though.
Yeah. So a point is, though, when you, as a manager, you want to see these really sharp, violent movements in any market, right? You don't want a long trend because it's not much you can do about it, right? But when you get to that real sharp movement, I'm grinning here now, anyone watching on the YouTube, and it just gives you that chance to do something. So with current oil prices, we're making money on this. We were right to get in when we did. We do suspect we're getting a bit of a pullback now. Like this is public knowledge, public information. You can find the sentiment readings right now on crude oil itself. There's DSI data. You want to go find it. It's sky high, right? So you should get a bit of a pullback here, but we haven't had that sharp acceleration with prices. Like, so Steve, like this could run higher. Oil could absolutely run higher. So if you're not in yet, then you might have an opportunity. If you're already in, then you deal with it. But the real risk here now with all commodities is not really with a declining, slowing economy. It's the supply lines that are coming up. So I know earlier today, and I don't know if you guys noticed it or not, but Russia announced that they're putting a temporary ban on gas and diesel exports. And I think, Rich, you said, well, it doesn't matter. They're still going to sell it to this place in that point.
To India.
Yeah, well, India will be buying it from Canada. We know that. But as soon as we get conflict in the world, I think the world's a lot closer to global conflict than not being in conflict. The ability to ship stuff around the world, like it gets choked, it stops. So like we're bullish on the oil sector, and it could come off a bit from here, but that's what we see happening. So we're not into that 2008 period yet, Steve.
Yeah,
but I'd love to see it, because then
there's another wrinkle to this number though, and which supports sort of Keith's view, but from sort of a macro, dare I say it, nerdy way of looking at it, is that we often look at these prices in nominal terms, but oil prices in real terms, so adjusted for inflation, is still actually relatively low. So what do I mean by that? Is like, let's say $100 a barrel today is not the same number as $100 a barrel was 15 or 16 years ago, right? So you have your CPI index has gone up, probably 50%. And so, it'll take, and in a sense, so that's why, so actually $100, it sounds like a really big number, but the prices of everything else have actually also gone up quite a bit. And so you're actually, in a weird way, you could say actually it sounds like a big number, but it's actually relatively inexpensive relative to the prices of everything else. Number one, it's also, I would argue, relative to to GDP, number two. So how would if you took every barrel that the human beings consume per day, which is about 100 million barrels of oil per day, 1 barrel of oil is 159 liters roughly, and you multiply that by the price, and then you divide that by the GDP. I know we're getting a little annoying here, but my point is like it's the stress that you have relative to your total productive capacity of your economy, in this case the world, is actually relatively low. And so just by that sort of math, you can actually see the oil price going much, much, much higher and still be well below what it was at that peak $140 barrel of oil mark.
I think it's it's good. I think it's an important distinction here. Like, all depends on like timelines.
Right. Absolutely.
Timelines, time frames. Clearly the oil can scream higher from here, but I think it's going to act as a natural break,
of course,
on the economy between yields, which are clearly going to slow borrowing and credit, and energy prices, which are going to hit the demand side as well. That again, these two markets are going to basically do the central banker's job for them.
Well, let's not underestimate the ability of good old Janet Yellen and the Treasury to very quickly, I suspect it's happening this week, to start to accumulate a very large short position in crude oil futures to try to bring this down. It's again, these things happen behind the scenes.
There's also, one more thing. It's also that the Saudis, that are the second largest oil producer after the United States. So US produces about 12, Saudi is 11, and Russia is maybe 10 million barrels per oil a day, and Canada's like fourth. The Saudis have cut production, right? So that's helped. Remember, folks, there's loads of oil. There's about 47 years of oil in the ground. Any price fluctuations are a function of supply, rather than like us not knowing where it is. So oil prices should not be this high. They're this high because of supply constraints, refining issues, right? We no longer build refineries in the West, which is stupid. And the Saudis have cut production by, what is it, Keith? I think it was like 1 or 2 million barrels. So they have a lot of space to open up the taps and keep that price down. So we'll see.
So when they cut by 1 or 2, it means we're actually increasing by 1 or 2. Everyone cheats on no one actually does the production number, but it's like that moral suasion, what you learn in school. They just have to talk about doing it, and then it all happens. But okay, so we have the other big.
Well,
Keith,
Bank of England.
I got the Bank of England.
Yeah.
Bank of
what
England
happened with the Brits?
Yeah. Rich, you want to walk us through that? That's your home.
Sure. I mean, so the Brits.
Rich, you got to use your British accent when you're doing it. That's fun.
I refuse to do that.
Come on, you're a cool guy.
No,
I bet you'll pick up a date. I'm sure you'll attract someone with this.
No, very much not. So we always talk about sort of what's priced in the market, and what we mean by that is the bets people take and make using the futures market for the US, or option adjusted spreads, or in Canada it's the bankers acceptance something contract, BACs, and in the UK the BACs, that's right.
Bankers acceptance contract.
I actually got that one. So in the UK, there was basically everyone was expecting them to raise by 25 basis points, and they didn't. And so that really caught the market offside. And some of the thing, and basically they argued that they're worried about growth. In the UK, you've had so we talked about the strong labor market in the US. In the UK, unemployment rate starting to rise. They have different measures of calculating it. One of them is called the ILO, which is the International Labor Organization. That started to go up. The total number of employment fell by 159,000 workers over the last 3 months. So that's material. And inflation, goods inflation, driven down by energy, has really slowed. In the UK, their housing market is absolutely cratering, both in terms of activity as far as mortgage lending, and year-on-year growth rates are negative. I think -3%, -4%, depending on which index you use. And so the UK, so the Bank of England, surprised by not raising interest rates. And Steve, one of the negative things that happened there was the pound got absolutely killed. Over 2 days, I think that the pound is down like 1%, which doesn't sound like a lot, but is actually a big deal for a currency, especially one as important as the pound.
So the pound was pounded, by the way.
You beat me to it.
Come on. So bad.
You're all over it today.
Yeah.
Keith's
This is
on
good.
fire today.
So you have the Brits, they're all of a sudden they're worried about growth coming up, right? In the Americans yesterday, they said, hey, yeah, growth is going to be a bit of a challenge. And, the Swissy, we always call it the Swissy, same thing going on with them. The Europeans, they downgraded all of their growth estimates the week before. And then you have Canada, what's happening in China, of course. So you have to be prepared and structured just in case the soft landing doesn't happen. Right? You have to. It's just natural. If you're not positioned for it, you're just missing a really good opportunity here. Which goes back to Steve. So I know a few weeks back, we started talking about, there is an opportunity coming up in the bond market, with the long bond or the 10 or 30 year. And we think so. Well, we're watching that. We're not in there yet, but it is a market. So right now for the Americans, right around 4.5% on the 10 year. And, it could absolutely go a bit higher. We sort of, instead of a level, we sort of look at it from a time range, price equals time, things like that. But, we talked about earlier this year, we're accumulating in the oil market and stuff like that. It is our expectation that equities, continue to come off here. But the biggest opportunity coming up, it could be in the long end of the curve of the bond market. And that's where you make your money, Steve. Everyone talks about the stock market when you make money. No one ever talks about in the bond market.
The bond market's much, much, much bigger than the equity market, just for people who may or may not know that. Sorry, I think people often forget because we're guilty of it. We always talk about the equity market. The news media, the mainstream media always talks about the equity market, but the bond market is much, much, much larger. Sorry,
so
Steve, go ahead.
The TLT, which is the long bond ETF, it's down 47% since peaking.
That's Bullard. That's been Bullard.
Yeah, so obviously it peaked in July of 2020, which was kind of like the lowest, the lows of the lowest interest rate.
And that's the point with the long bond. It has this leverage effect built into it.
Well, especially when yields are 0%, right? So it's non-linear, as you say, Keith. Sorry.
Yeah, like where else do you expect yields to go when they're at zero? There's only one direction. I mean, it's but think about all the big pension funds and stuff, and even a lot of the banks with the regulatory capital. They bought a load of let's call them the French banks, right? To be truthful, they bought a ton of debt, negative yielding debt. And now all of a sudden, if they put these marks on their books, it's like gazillions in. By the way, gazillions is not a real number, right, Rich?
It's not?
No, it's like the Great Gazoo. Remember that guy from the Flintstones? Was he real or not? Nobody knew whether he was real. I think so too. It's not a good example then. But anyway, there's a lot of big money out there that are sitting on some pretty big losses right now. Because rates, long rates have gone from, 0 or even negative in some places, up to this, 3.5%, 4% plus world. And that's where all the, you start to see some bodies coming out. But the real opportunity, if you're able, if you have some good models and identify when it's there, being able to go long, I mean, you're buying long-term bonds. That could be the great trade. But just imagine you're at a dinner party. One guy's talking about, the fancy stock he made all the money in. What did you mention earlier? Was it GameStop? You said the movie was being made about?
Yeah, I'm going to try to find the name of the movie. Give them a free plug here.
Yeah, I made money on, I made lots of money on GameStop. And then, Steve's in the corner of the room. Yeah, I just made 25x on my long bond allocation.
The movie's called Dumb Money.
There you go.
But by the way, just before we sign off, I know you're going to boot us out of here, Steve. But we will talk about this next time. But there's a case that yields go higher.
Well, yeah, I mean, they.
I am not calling for rates to hit the I think they can go higher. Let's just be clear. I don't
Okay,
want to
cool.
cause
Don't want to cause confusion.
I know Steve looks like he's had enough fun for the day. He's ready to close things down.
Oh man,
here.
all this chatter for these of yields going higher for these real estate guys. It's
Making you sweat.
yeah, making them sweating over here. It's
well, I got to make my football prediction for the week.
Oh, yeah, of course.
Yeah,
Wait,
so
who are
the
they playing?
Well, they're playing Thursday night games. And by the way, if anyone ever bets on football, you always avoid Thursday night games because you don't know what's going to happen. And you also kind of want to wait for the fourth week of the season to get going. Then you figure things out. But so guys, we're 2-0 this year. Loonie Hour is doing well. And this could be a sloppy one tonight. But I have it as the San Francisco 49ers hitting 33 and the New York Giants, or the G-men, getting 2 field goals, so 6.
Come on. That's a terrible prediction.
33-6.
33-6. All right, go Niners.
Go
You heard it here
Niners.
first, folks.
Keith, I've had a special request from one of our listeners too. He insisted on you letting him know and our listeners know when the ice cap fund there gets long TLT.
Oh, we're gonna get in trouble. You guys gonna get me in trouble.
So that might be an off the record conversation, but
Yeah. I think I know
anyways.
which one you might talk about, but we'll see. We'll see with that one.
Yeah, so TLT not there yet.
Oh, I thought you meant the football betting fund.
Oh,
What a
God.
horrible
Well, it's
fund
been
to
really nice
invest
knowing
in.
everybody.
And that's a good spot to wrap it up. There you have it from the Soft Landing crew. We'll see you next week.